Hi, I'm Claudine Cohen, Managing Partner of Value 360 at CohnReznick. Welcome to Dealmakers Unplugged. Today I have Matt Bernstein from Siguler Guff joining me. Matt, hi, Happy New Year, good to see you, and thank you for participating.
Yes, great to see you as well, Claudine. Happy New Year, and thanks for having me.
So, Matt, maybe, as we kick this off, you could just give a little bit of a background as to Singular Guff and who you work with and what the different strategies are.
Sure. So I'm a managing director here at Siguler Guff in the credit strategy. As a firm, we're about a $20 billion asset manager, and my group specifically is a private credit strategy that invests primarily across specialty finance, asset-backed lending, and corporate lending. I personally spend most of my time on the corporate side, where we have a pretty flexible mandate that invests across industries and up and down the capital structure. So we'll do senior debt, junior debt, preferred equity, or common equity as well. And generally, we're focused on the middle market. I'd say businesses that are 8 million of EBITDA and above. We work with sponsors. We work with independent sponsors or fundless sponsors. We work with family offices. And then we also work with what we call non sponsors or management owned businesses as well.
And that's where you and I met, was actually around the independent sponsor community, as you were looking to work with independent sponsors and see how you could facilitate deals and transactions.
Yes, exactly. I mean, it's as you know, that community has been around for a while, but I think more and more prevalent in deals and their ability to find proprietary deals in markets that maybe the bankers are holding back on selling deals is one we continue to penetrate on, and so we've closed a variety of deals over the past few years here at Sigler Guff with independent sponsors, and it's definitely a part of the focus here for the go forward as well.
That's great. And we'll talk a little bit more about that later on. But, maybe what we saw, in the back half of 2025, and, we 3 weeks, not even 3 weeks in for 2026, but deal activity certainly picked up. It seems, there's a lot more consistency in terms of the level of deal activity. Sell side mandates seem to be ramping up. Um, we went for a long period of time where we saw very few sell side mandates.
Yep.
But maybe you can, give your perspective on your outlook for 2026.
I think in order to kind of focus on 2026, it's important to maybe reflect back slightly on 2025 because I think that transition really tees up where 2026 is going to land. But when we look at 2025, our group had a great year in 2025. But I think it's important to just take a step back and look at generally some of the macro views. So 2025 was, as we all know, a year of up and downs. You had geopolitical risk, you had elevated interest rates, and you had policy uncertainty from a new presidential regime that came in. But I'd say overall, I felt the economy was relatively resilient there. In looking at some of the reports that have come out for the M&A markets for the 2025 year, when you look at M&A volume, it was flat to slightly down from where things were in 2024. And again, 2024 was down from some of the post-COVID boom we saw in the M&A market. When I look at 2025, you kind of have to break it into two parts. Liberation Day obviously impacted the first half of the year, and M&A markets were pretty slow in the first half. But I think towards the back half, as you said, things started to pick up significantly, and I think that'll roll into 2026 in terms of the pipeline.
Here, when you talk about volume, being flat, I think you said flat against 24. It's interesting because we didn't see that as a practice. Our volume is up around 25%,
Yeah.
even 30% just on volume. Now, it might just be our client mix and who we work with, an industry mix,
Yep.
but it's interesting.
Yeah, and that was kind of data that obviously through research and in terms of what we look at in our business, that's volume by count, the number of deals. I think the dollar amount of M&A dollars that were put into the market was actually up, so larger transaction sizes, but the number of deals or the count was pretty flat versus 2024. And I think a lot of that obviously was driven by the first half of the year. You saw a big pickup in the back half of the year, as I mentioned. When I look at my market or the credit markets, you saw a lot of spread compression in 2025. That's obviously driven by the private credit markets having a ton of dry powder, as we all know. When we look at rates, and I think it depends on where you play in the market, but generally interest rates in private credit were down somewhere in the range of 1 to 2%, as I said, depending on where you play in the market from historical trends, and rates were the lowest since pre 0809 as well. When I look forward to your initial question into 2026, we have a very strong pipeline. In talking with bankers, there's a pretty robust pipeline for bankers of deals that are coming into market. There are still some economic headwinds to deal with, but I think looking at the credit markets, I think the competitive intensity that we saw in 2025 will definitely still be in play here in 2026. And I think lower spreads overall will sustain likely given some of that supply and demand imbalance that we saw, as I stated earlier. But I would say history suggests from the data we've seen and just being in the market that rates, really can't remain at such low levels for such an elongated period. So eventually we feel like that'll come up. And for our business itself, as refinancing needs increase for borrowers that are highly levered at, overall higher rate environments, that's going to cause some credit stress. And for a strategy that like ours, that's very flexible and plays across different types of asset classes, it's a very compelling opportunity for us to deploy into 2026. So we're very excited about the year to come, and a lot of those factors play into 2026 being a great year.
So on the interest rates, it's interesting. So you say that rates are down about 1 to 2% and they're lowest since pre 2008 levels. Is that what I heard?
That's
In
correct.
credit,
Yes.
in private credit. But that's
Generally in the lending market, but as I said, it really depends on where you play. We generally play in the middle market, so that's why I gave the range of 1 to 2%. It's really just some of the data points that we see in our market, but looking at some of the data for 2025 within the credit markets as a whole, it can range from 1 to 2%.
is that enough to stimulate a lot of deal activity? Is it that significant? I mean,
It is, and I think the rate compression is really driven by the competitive dynamic that I mentioned earlier. There's a ton of dry powder in private credit. A lot of credit funds, including us, have raised a lot of capital, and there's a lot to deploy. So that's what's driving the lower rates is the competition. There was limited M&A activity last year, as I said. So for the deals that were around, a lot of people were circling those, and the competition drove those rates. And we can talk more about structure, as you said, as well as part of this conversation.
what I've heard is no further interest rate cuts, maybe middle of the year, but one and then that's it. So that doesn't bode well for rates coming down more.
Correct. Correct.
Okay. It's just merely, obviously, it's the competitive nature. If there's so much dry powder out there, that can have an impact. But
A
it won't
hundred
be
percent.
driven by. Okay. So as you look at where you're at now, do you feel like credit terms are easing a little? People are looking at deals differently. I don't know. Is it easier today to go and finance a deal? What does the leverage model look like? Or the
Yeah,
leverage.
sure. So just looking at last year, before I get into structure, I think it's important to hit the transaction types that we saw last year. I'd say, given some of the factors I mentioned before in the M&A markets, a lot of the transactions that we saw, and that in talking to bankers, as a mix of their deals that they brought to market, it really was the vast majority around refinancings versus new M&A platforms. So ultimately, that's what drove last year. I think as M&A picks up, that mix will hopefully kind of get more to a little bit more balance between refinancing activity and M&As. But I think, as I said before, as companies who have high leverage and need to refinance in these higher rate environments, the credit stress is likely to emerge, and that'll push continued refinancings over the period. We also saw within the refinancing world a lot of dividends last year. I'd say that is really driven due to the tough exit environment for sponsors. So sponsors have been pushing bankers to go out and raise capital to pay them dividends to ultimately distribute to their investors last year. So in some of the data I saw, the quantum of dividends for 2025 were some of the largest since 0809 as well. So those are some of the transaction dynamics we saw. From a structuring perspective, given a lot of the competition I mentioned in credit markets, structures have pushed from a pressure perspective as well. So you're seeing a lot more covenant like deals, and you're seeing overall looser legal terms as well in the market. Now, we like to stay very disciplined in our investing, but I think a lot of folks, in order to win a deal, are maybe becoming looser with some of those terms as well. You're also seeing more structure in deals as well from a source perspective, and by structure I mean less cash up front, and that may translate into more rollover equity, more earnouts, more seller notes as well versus more cash up front, and playing into the independent sponsor community, which we were mentioning before. That community continues to grow and grow and grow, and the volume of independent sponsor deals has grown, at least from the deals we're seeing over the last few years. And the structure of the independent sponsor deals are definitely weighted towards less cash up front and more structuring through seller notes or earnouts and such. So that's kind of what we saw the last year. And I think, again, playing back into the lower rates driven by the competition, I think those dynamics from a structuring perspective will still play here for the next year as well.
So there's an interesting dynamic because you've got some things that are maybe, going against ease of credit or pricing, just because discipline, economics, deal structure, how aggressive can the buyer be in terms of rollover equity, earnouts, and that. And then you've got this competition in credit markets with there being a lot of money out there, and still some uncertainty, I think, around what the economy is going to be doing, consumer confidence, all these things. But overall, I mean, it seems though that it's a great environment to get deals done and that money is plenty.
Yeah, no, I totally agree. I think it's a great environment. There's a lot of opportunity out there in private credit. I think our strategy is a bit more differentiated. Where we differentiate is how we structure deals. As I said, we have a very flexible mandate in terms of the product offering we have, our speed, and overall comfort with dealing with complexity. So I think you have a lot of the middle of the fairway lenders, which we like that as well, but we also can deal with more complex situations across different asset classes as well. So we are very excited personally in terms of what's to come into 2026 here.
Got it. And, maybe a year and a half ago, I had sat on a panel with private credit. And at that time, just given where the economy was, senior lenders were totally out of the market. You just weren't seeing them. And it was like just unbelievably good for private credit. And then there was the discussion as things improved, as interest rates eased and that, and the political situation started to settle down. We kind of knew where who the new administration was, and that senior lenders and traditional banks would come in, and maybe that would negatively impact private credit because there were so many players out there, so much money, and now you had this added competition. What are your thoughts on that?
Yeah, no, it's a great point. Listen, I think private credit obviously has been around now for a while, and there's always been that competition amongst the private credit community, but also with banks. And I think it just depends on what the borrower is looking for. With the big differentiation obviously between private credit and banks is overall flexibility, whether it's on the documents, going out and doing an M&A transactions, covenants, and just overall day-to-day dealings. But it's also leverage levels. Banks are tapped out at certain leverage levels due to regulatory reasons. So there's a variety of factors. And overall speed and relationship, we value ourselves as relationship oriented with our borrowers. We work a lot with sponsors, as I said before, and independent sponsors. We also work directly with management teams. So we're very relationship oriented, and you want to be able to be nimble and get things done very quickly. Obviously, with still going through your underwriting and your diligence, but I think that's the big edge when you weigh working with a bank versus private credit. I think it's an obviously a fact we're not going to be able to compete from a pricing perspective with banks, but I think some of those other factors people value more, and ultimately that's why on a lot of deals we're beating banks because of those factors. But we also work a lot with banks as well and partner with banks, so we think it's a part of the community.
Great. Before we close out today, would just like to hear from you if you were talking to somebody who's in the market for credit, specifically maybe an independent sponsor because of some of the challenges they have. You know, what advice would you give to them if they were coming to sit in front of you? What is a go versus a no go?
Sure. No, so I think there's a variety of factors that we look at when we're looking at a given deal. I'd say generally industry is an important starting point. We're industry agnostic, as I said before. We have a lot of expertise in business services, in particular IT services. But I think starting with the industry is really important. You want to be in strong end markets and stable end markets that are hopefully growing as well. So we always look at the industry and the industry dynamics there, and what the competition looks like as well. We also like to see some sort of reoccurring or recurring revenue base as well with a diverse set of customers. But I think ultimately, when it boils down to it, there are probably two key factors that we look at outside of those. It's the cash flow profile of the business. Obviously we want the business to be have enough cash to service our debt, but when you look at the margin profile of a business, whether it's their fixed cost profile versus variable costs, and their flexibility to flex those expenses up and down depending on the environment, looking at the cash flow profile not only to just service our debt, but how much cash flow can they service in a down environment as well. So we really dig in hard in terms of the cash flow profiles of businesses, and that plays into overall economics and how much your debt is priced, and how that plays into the overall debt service as well. We also, as I said before, we value management teams. We are relationship oriented, as I said, and we do a lot of diligence around the management team, because ultimately you're riding with that team. Even if there's a sponsor, an independent sponsor involved, the management team is mission critical to any deal. So putting the right team in place is really important for us. And those are, I'd say, the key factors. Ultimately, we're cash flow lenders. We're not asset based lenders in terms of the corporate side. But what I would say on that is, when we like to look at enterprise value in our analysis as well, and what our loan to value is and how that plays into all of this.
Okay, great. Well, Matt, thank you so much for joining us on this installment of Dealmakers Unplugged. Good to see you. Um, and hopefully we'll partner together on lots of deals this year.
Yeah, no, Claudine, always a pleasure catching up with you, and really appreciate the opportunity. And we value your firm and the relationships, and we look forward to a prosperous 2026 here.